HOOK, the assumption that needs to be challenged money was meant to make life easier, to give people freedom of choice, to allow societies to grow, to let effort turn into security. So here's the mystery. Why does a world overflowing with money feel increasingly restrictive? Why do governments talk as if they have no options, and citizens feel like they're running faster just to stand still? What if currency didn't lose control? What if it became control? And what if freedom wasn't taken away, but slowly priced out? Setting the stage money as a promise for most of history, money had a simple role. It was a claim on something real: gold, silver, land, or labor already performed. Money didn't command behavior, it recorded value. That's why money once acted as an escape valve. You could save it. You could leave with it. You could step outside the system. But modern currency works differently. Today's money is not a claim on the past. It's a claim on the future. And once money moved into the future, control followed. Origins: when money detached from reality, the turning point wasn't a single event, it was a sequence. First came state borrowing, then central banks, then permanent public debt. Governments discovered they could spend now and pay later. Over time, later stopped arriving. The final shift happened when currency was severed from physical limits. Once money no longer had to be scarce, it no longer had to be neutral. From that moment on, currency could be used to guide behavior. Interest rates rewarded borrowing and punished saving. Inflation erased obligations, selectively credit access determined participation in society. Money stopped reflecting value. It started shaping outcomes. The RISE currency as an instrument of control. As this system expanded, a quiet agreement formed. Governments would run deficits. Markets would absorb debt. Central banks would step in during emergencies. In exchange, stability would be maintained, not through balance, but through constant intervention. This is when freedom became conditional. To buy a home, you needed debt. To start a business, you needed leverage. To live normally, you needed access to credit. Currency no longer asked, "What have you earned?" It asked, "How dependent are you?" The breaking point when choice disappeared. Every control system eventually reaches a stress point. For currency, that point arrived when debt became too large to repay, but too important to fail. At that moment, choice vanished. Governments couldn't raise rates without triggering collapse. They couldn't cut spending without unrest. They couldn't repay debt without destroying the system itself. So they did the only thing left. They managed time. Debt was rolled over. Crises were postponed. Emergency policies became permanent. Currency didn't break. Crises were postponed. Fallout: the cost of managed money. The fallout wasn't dramatic, was gradual. The fallout wasn't dramatic, it was gradual. Savings lost purchasing power. Crises were postponed. Wages lagged permanently behind costs. People didn't lose freedom overnight. They lost options. You could still choose, but only between approved paths. Work longer Borrow more, delay life. Currency became the silent enforcer. No laws needed, no force required. Prices did the work. Failed fixes why reform never restores freedom. Every crisis brings promises. Better regulation, smarter policy, fairer systems. But these fixes never touch the foundation. You cannot restore freedom with a currency system designed to discipline behavior. You cannot fix dependence using tools that require dependence to function. Even reforms that succeed only strengthen the same architecture: more rules, more oversight, more management. The system survives. Freedom shrinks. Modern parallels, the pattern repeats. Look at the world today. Global debt exceeds $300 trillion. Central banks intervene routinely. Emergency tools never fully disappear. Entire generations postpone ownership, families, and stability, not because currency no longer stores value reliably. This isn't a coincidence. It's the predictable outcome of a system designed to survive crisis, not eliminate it. The secret agreement: control. Without coercion, there was never a signed contract. The agreement is structural. Currency must remain elastic, debt must remain permanent, stability must override freedom, governments stay solvent, institutions stay powerful, citizens adapt or fall behind, control flows through currency itself. 3 takeaways: what this reveals. First, money stopped being neutral when it became unlimited. Second, currency controls behavior more effectively than laws ever could. Third, a system designed to survive permanent crisis will always prioritize control over freedom. Warning: the long-term risk: a society that prices freedom eventually rations it. The danger isn't sudden collapse. It's normalization when permanent constraint feels natural and dependence feels inevitable. When people stop asking what money is for and only ask how to keep up. Open-ended thought: if currency defines the boundaries of your choices, is it still money, or is it something else wearing the same name?